Welcome to video 1 of part 2 of the EA Tax Training free EA exam prep course for 2025. My name is Tom Norton. I am both a certified public accountant and an enrolled agent, and I will be your guide and instructor throughout this course. Before we get started, I would like to remind you that you can get a free copy of the slides for all of these videos in this course. In the description of each video is a link where you can have a PDF of the slides for that video emailed to you. Part 2 of the EA exam is all about business taxation. We've got 9 videos for you in part 2. This first video you're watching now is about business entities and getting started. Video 2 is about accounting methods and business income. In video 3, we'll talk about assets and depreciation. Video 4 covers deductions and credits. In video 5, we'll talk about sole proprietorships and partnerships. Then in video 6, we'll talk about C corporations. In video 7, we'll talk about S corporations. And then videos 8 and 9 are about specialized returns. One important point about the 2025 exam and this course: the 2025 EA exam, officially known as the Special Enrollment Examination, or SEE, is based on the 2024 tax law. Specifically, it is based on the law as of December 31st, 2024. So that is what we will be dealing with in this course. As always, I look forward to guiding you through all of these topics. So without further ado, let's jump right into video 1, business entities and getting started. Specifically, what we will cover in this video is the types of business entities that you'll be dealing with in preparing business tax returns. And then we'll talk about getting started as a business. Then we'll talk about some reporting requirements other than just the income tax return. And we will finish off by talking about worker classification. If you were with us in part 1, you know that near the beginning of each of these videos, we list out the free resources that are available to you from irs.gov for that video. The exam questions for the EA exam come primarily from IRS publications and form instructions. So what we are doing in this course is teaching you the material that you need and then also pointing you to the most relevant IRS publications for each of the topics. And what we have is the ones in bold are the ones that are most important for you to get and to read for that particular video. So for this video, we are looking at publication 583, Starting a Business and Keeping Records, and publication 334, Tax Guide for Small Business. Those are the two that you will definitely want to get and read and study for this video. Then we have these other publications listed here as well that you may want to check out to get more information about those specific topics. So let's start by talking about business entities. First thing to know is that there are several different types of entities that you may be dealing with and tax return types that you may be preparing as a tax preparer. There's also a distinction between state law entities and income tax entities. So for each type of entity that you might form or have under state law, there will be a tax return that is appropriate to file for that entity. However, you have some entities that are defined under state law that do not necessarily have a corresponding tax return. And you have some entities that you have a tax return for that don't have a corresponding entity under state law. So this chart shows you some of the differences. So for example, sole proprietors and partnerships, we have those under state law, and we also have tax returns for each of those. Then there's something called a qualified joint venture. This is not something you'll find under state law, but it is a tax return concept. And you can see the two asterisks there. Not technically a separate tax entity, but it does receive special tax treatment. So we will talk about the qualified joint venture. Then you have the limited partnership and the limited liability partnership. These are entities under state law, but there is no separate LP or LLP tax return. Instead, those would be classified just as a partnership for income tax purposes. Then we have a corporation, which of course is an entity under state law, but there is no just corporation tax return. For tax purposes, it will either be a C corporation or an S corporation. But a C corporation and S corporation is not a state law concept. If you go to the state, you're just going to form a corporation. You're not going to form a C corporation or an S corporation. Those are tax only concepts. And then finally, a limited liability company is an entity that you form under state law, but there is no such thing as an LLC tax return. An LLC will be taxed as one of these other type of recognized taxable entities. Now, of course, the IRS knows that all of these entities exist. They acknowledge their existence. It's just that there is not a tax return specific to each of them. So we're going to go over each of these briefly in this video, and then in later videos, we will cover each of the taxable entity types in much more detail. So let's look first at the sole proprietorship. This is for a single owner and it is not incorporated. So you do not have to go to your state Secretary of State's office and file anything or notify anyone. You can just start doing business and you are a sole proprietor. Now, you may need to register with the state as a fictitious name or doing business as if you are using some business name other than just your name. So, for instance, if your name is Mary Smith and you're doing business as Smith Bookkeeping, then you would register with the state to let the state and the public know that Smith Bookkeeping is actually owned by Mary Smith. It just costs a few dollars and you're not forming an entity. You are just filing this notice with the state. You also may need to get a business license from the city or county where you live. So you will always want to look at that. But again, you are not forming an entity, you're just getting a license. A sole proprietorship is the simplest way to do business. You can just decide, I'm going to start a business, go out and start that business today, and that's it. You are in business. You are a sole proprietor. The biggest downside to the sole proprietorship is liability. So if you are sued, then you are going to be sued personally, and so your personal assets are at risk. And a lot of people get very upset about this and very uptight about this. But for most businesses, you can offset most of that risk by buying insurance policies. So there are general liability policies you can get. For some businesses, you can get something called errors and omissions policy. Even automobile insurance policies can help. So it is definitely a downside. It's something you want to keep in mind, especially as your business gets bigger. But insurance can offset much of the risk. And we'll see this same thing coming up with some of the other entities as well. For the sole proprietorship, there is no separate tax return that you have to file, and that's unique. All of the other entities we're going to talk about, you do have to file a separate type of tax return, but you do not with a sole proprietorship. Instead, what you're going to do is attach a schedule to your Form 1040. It's Schedule C, unless you have a farm, and then it is Schedule F. But most of the time, we're just going to be talking about Schedule C to keep it simple, but you'll know that if you are in a farming business, then it would be Schedule F instead. All of your income is going to be taxed at your personal tax rates. There's no separate tax rate for the income that you have from your business. And all of your net income is going to be subject to self-employment tax, which is a replacement for Social Security and Medicare tax. If you were with us in part one, we did talk about self-employment tax, and we will be talking more about it here in part two. Self-employment tax is then reported on Schedule SE. So if you have a profit from your business, you're going to owe self-employment tax. So you'll actually be attaching Schedule C and Schedule SE to your Form 1040. And you could potentially actually be attaching other forms to your 1040 related to your business as well, but you will have at least those two. So what are the pros and cons or advantages and disadvantages of having a sole proprietorship? Well, the advantages are they are simple to set up and run. They are taxed on your personal tax return, so there's no separate tax return. There's no double taxation that we'll talk about with a C corporation. If you have a loss in the business, you can use that loss to offset your other income. So maybe you've got a regular W-2 job and then you have this business on the side. Well, if you have a loss from the business, then that will help to reduce your overall income and therefore reduce your income tax. You can fully deduct health insurance and set up a retirement plan as a sole proprietor. And you can take that qualified business income deduction on your Form 1040. You'll remember that from part one, where you can deduct 20% of the profits from your business as a qualified business income deduction. The disadvantages, as we said, personal liability for business losses and lawsuits. You are it. There is no entity to sue or to lose money. If you are losing money or if you are being sued, then it is coming out of your personal assets. All of your income is subject to self-employment tax, as we said, and there are some fringe benefits that you may not be able to get as a sole proprietor that you could get, for example, if you owned a corporation. Our next type of entity is a partnership. This is where you have more than one owner and it is not incorporated. So it is kind of an extension of the idea of a sole proprietorship, because you don't go to the state and file anything. It's just two or more people who decide to go into business and they start doing business. Just like a sole proprietorship is only one person that just decides to go into business and then starts doing business. So nothing to file. You don't have to register with anyone unless you need that fictitious name or you need a business license. It is relatively simple to start. You can just start doing business, but it is a good idea to have a written partnership agreement, but it is not required. We'll talk a little bit more about it later, but best practice to have one, but you do not have to have one. The biggest downside, again, for a partnership is liability, and it's even worse than with a sole proprietorship, because with a partnership, not only can you be sued for what you do in your business, you can be sued for what your partner does in your business. So you are partners. If your partner does something wrong and you end up getting sued, then your personal assets will be at risk, even for the things that they did. Of course, you can still get business insurance to help offset some of that risk. For a partnership, you do have to file a separate tax return. It is called a Form 1065. The partnership is considered a pass-through entity for tax purposes, meaning it usually does not pay income taxes itself. So you don't have income tax at the partnership level. Instead, the profits or the losses are going to be reported to each partner on a Form K1, and the partners will then report those profits or losses on their separate tax return. For example, if the partners are individual people, then they will report that income or those losses on their Form 1040. So the profits are said to pass through to the partners. And this is a good time to mention that the partners do not have to be individual people. That's how we talk about it most of the time. But the partners could be corporations, for example, or partners could be another partnership. They could be a partner in a different partnership. So it's easiest to think about it as an individual, and that's how we'll kind of think about it most of the time. But we don't want to lose sight of the fact that the partners in the partnership can be one of the other type of business entities as well. This last point here says the partnership may or may not distribute its profits to the partners. So the partnership has profits. That doesn't mean they are necessarily distributing any cash out to the partners. But that doesn't change anything from a tax standpoint, because the partners are going to pay taxes on the profits whether they are distributed or not. So let's say you have two partners, they're equal partners, and the partnership makes $50,000 for the year. Each partner is going to have to pay tax on $25,000 of income for that year, even if the partnership doesn't give them any money to pay the taxes with. So maybe as a business, they decide, well, we need to keep this $50,000 in the business in order to expand or to buy more inventory or to buy some machinery or equipment that we need. That's fine, of course, they can do that, but then those partners are going to have to come up with the money to pay the tax from somewhere else. Next, let's talk about that qualified joint venture. This is a tax-only concept. It is not part of state law. This is where you have two owners who are a married couple and they are not incorporated and have no other state law entity. So essentially, this is a partnership between spouses. That's what we're talking about. And they have not gone to the state and formed an LLC or an LLP or a corporation or any other type of entity, but they have to be spouses. So under state law, this would just be considered a partnership. But for tax law, they are allowed to treat the business as if it were a sole proprietorship. Now, in order to qualify for this, both spouses must materially participate in the business. Back in part one, we talked about the passive activity loss rules and material participation. Essentially, this means both spouses need to work in the business. You don't have one spouse who's actively working in the business while the other spouse is just a silent partner or barely doing anything in the business. They both have to be actively working in the business, and both spouses must agree to treat it as a sole proprietorship. For a qualified joint venture, there is nothing to file with the Secretary of State because this is just like any other type of partnership as far as the state is concerned. It is simpler, though, than a partnership for tax purposes because you don't have that separate tax return that you have to file. But it does still have the same liability as a partnership. So if you are sued, you can be sued for something you do or for something that your spouse does. So you've got those same risks, just like any other partnership. For the qualified joint venture, as we said, there is no separate tax return. That's the advantage here. You do not have to file a Form 1065. Instead, you're going to do something that's very unique. You're going to report on two separate Schedule Cs, one for each spouse. So each spouse is going to report their share of income and expenses on their own Schedule C. So if you've got two spouses and they're equal partners, you're going to put half of the income and half the expenses on one Schedule C for one spouse and half on the other Schedule C for the other spouse. The income is still taxed at personal tax rates. There's no separate tax rate for the business. And all of that income is still going to be subject to self-employment tax. However, you are also going to have two separate Schedule SEs to report the self-employment tax. So you'll have two Schedule Cs and two Schedule SEs, and each spouse will get credit toward their own Social Security for their portion of the profit. So this is really why we need two Schedule Cs and two Schedules SEs. As you may know, the Social Security system in the United States, you work throughout your working life, you earn money, and the amount of Social Security that you get when you retire depends on how many years you worked and how much money you made, and so how much you paid into the system. And so by filing your separate Schedule Cs and Schedule SEs, each spouse is getting credit for their own work that they did for their own Social Security. Our next entity is a limited partnership. So this is a special type of partnership with at least one general partner and one or more limited partners. This is formed under state law with the Secretary of State. The advantage is that the limited partners are liable only for the amount they have invested in the partnership. So they are protected from being sued for more. So they've invested some money in the partnership. If there is a lawsuit against the business, that's all the money they can lose, is the amount that they have invested in the partnership. However, the general partner is still personally liable and at risk, and there does have to be at least one general partner. This does just default to a partnership for tax purposes. So there is no limited partnership tax return. It is just going to be a partnership like any other partnership as far as the tax law is concerned, though the LP can elect to be taxed as either a C corporation or an S corporation if they are qualified, and we will talk more about that later in this video. Next entity is a limited liability partnership. So this is a special type of partnership designed for professionals such as doctors, lawyers, accountants, and architects. For this, each partner is protected against the liability for the malpractice or negligence of the other partners. So you can imagine if you've got doctors, for instance, who are partners, and let's say they're surgeons, and one of the doctors messes up a surgery and they injure or kill someone, well, of course, that patient or their family is likely to sue the doctor for that. Well, if you just had a regular partnership, both doctors would be on the hook personally for that one botched surgery that only one of the partners actually did. So a limited liability partnership protects the partners against the acts of the other partners. Most states will require those partners to have malpractice insurance. But of course, people in these professions, doctors, lawyers, accountants, architects, will tend to have some sort of malpractice insurance anyway, but usually it will be required by the state. These are formed under state law with the Secretary of State. And like an LP, it does default to being taxed as a partnership for tax purposes, but they can elect to be taxed as either a C Corp or an S Corp. So, what are the pros and cons of being a partnership? Well, the advantages are it is relatively simple to set up and run, it is flexible in allocating profits and making distributions. So, oftentimes, when you've got two or more owners of a business, they try to decide should we be a partnership or should we be an S corporation? That is one of the common decision points that businesses have. And when you are comparing those two, being a partnership gives you more flexibility when it comes to allocating profits amongst the partners and making distributions to the partners. So we'll get more into that in the videos where we talk about the specific type of entities. The partnership is a pass-through entity, so that means that there is no double taxation because the partnership itself does not pay any taxes, only the partners do. Also, net operating losses pass through to the partners to offset their other income. So, if you got individuals, for instance, who are the partners, if there is a loss from the partnership, then they can actually use that loss to offset their other income on their personal tax return. Next, the partners get basis in the partnership for guaranteeing partnership loans. This is another difference with an S corporation. And why this is important is because the partners in the partnership may be able to deduct some of the losses from the partnership that if they were an S corporation, they would not be able to deduct because the partners get basis for guaranteeing partnership loans, whereas S corporation shareholders do not get basis for guaranteeing loans of the S corporation. So again, another important factor when you're trying to decide between being a partnership and an S corporation. And then finally, the individual partners. So if they're individual taxpayers, they do get the qualified business income deduction on their Form 1040 for the income from the partnership. Disadvantages of being a partnership: the general partners do have liability personally for the acts of any of the partners in the partnership. The distributive share of the income is all going to be subject to self-employment tax, which that can be different again than an S corporation, for instance. The income is going to be taxed whether it is distributed or not, as we discussed. There are some fringe benefits that the partners will have to pay income tax on, or that they may not even be able to get because they are a partnership rather than a corporation, for example. And disputes between the partners can be costly and time consuming. So there have been a lot of friendships and family relationships that were ruined by a business partnership gone bad. This is why it really is best practice to have a written partnership agreement, even though it's not something you have to file with the state. You can go to a lawyer, you can have the partnership agreement written up so that everybody understands how things are going to work, how profits are going to be distributed, what's going to happen if business doesn't go well and you have to dissolve the partnership. You want every conceivable circumstance spelled out in writing so that everyone knows about it, everyone agrees, And hopefully you can help preserve your relationships if something goes wrong with the business. Our next entity is a corporation. This is a state law entity, and it is considered a separate artificial person for most purposes under state law. It must be formed, of course, under state law with the Secretary of State. The owners are called either stockholders or shareholders, and their liability is limited to the amount they have invested. So this is the major reason why corporations were formed in the first place, was because business owners were sick of getting sued and having their personal assets taken due to lawsuits. So they formed corporations so that the owners would not be liable personally for what the business did. So the corporation is considered an artificial person. So if you want to sue the corporation, you are suing only that artificial person, not the individual owners of that corporation. The next point, it was also very important for why they started corporations in the first place, is because they can raise capital very easily by selling shares of stock. So they have these different shares, they can sell those to the public. You've probably heard of an IPO, an initial public offering. That's when a corporation goes out for the first time and sells their stock to the public in order to raise money. And they can do other offerings of stock after that first time as well, anytime they want to raise money in order to have capital to run the business. Now, corporations do have the most paperwork and other administrative requirements of all of the different types of entities. So, for example, the corporation has to have a board of directors, and that board of directors has to have regular meetings. Usually, they have to be at least annually. You have to keep minutes of those meetings. You have to have corporate resolutions to enter into certain transactions. So, it might say if you have a transaction over a certain dollar amount, then there has to be a corporate resolution that authorizes that. Or if you're going to borrow money over a certain dollar amount, there has to be a corporate resolution to authorize it. So all of these resolutions and these minutes and these records have to be kept in something we call the corporate book. And you have to make sure that you've always kept this book up to date. Then you also have to have stock certificates, and you keep track of these stock certificates in the logbook about who is receiving them. And then you're also going to have at least annual filings with your state, and you're going to have to pay fees every year when you make those filings. And it is very important to do these things. These are the formalities of being a corporation. A lot of times, small businesses especially, they'll form a corporation because they've heard it's a good idea to protect themselves from a liability standpoint, but then they don't keep up with all of these formalities that you have to do, and that can defeat their whole purpose for being a corporation in the first place. So here's what can happen if you don't keep up your corporate book and you don't follow all of these formalities. Let's say the business does in fact get sued. What can happen is the lawyer who is suing you, they can come and look at all of your records, and they can get copies of your corporate book and all of these records. And if you're not doing all of these things that you're supposed to do, then they can go to the judge and say, hey, look, they are a corporation in name only. Yes, they went to the state and they filed for a corporation, but they're not acting like a corporation. They don't have board minute meetings. They don't have corporate resolutions, etc. And so then they can say, not really a corporation. We should ignore the corporation. This is called piercing the corporate veil. And then they can go after the individual owners personally. So the whole reason to get the corporation was to protect from liability. But if you don't do all of the things you need to do, then you can lose that liability protection. For tax purposes, a corporation is either going to be a subchapter C corporation or a subchapter S corporation. So they are not just a corporation, it's one or the other. They are a C corp or they are an S corp. A corporation will default to being taxed as a C corp. So if you just go form a corporation and start doing business and you don't file any other paperwork with the IRS, you are automatically going to be a C corporation. However, the corporation can elect to be taxed as an S corporation by filing this Form 2553. So we will talk about that a little bit later. A C corporation is considered a separate tax-paying entity from its owners, and they must file this Form 1120. That is the C corporation income tax return. So just like they are a separate artificial person under state law, if they are a C corporation, they are a separate taxpayer under the tax law. So that means the corporation itself is going to be taxed on its profits, and they are taxed at a flat rate of 21%. The corporation may distribute its profits to its shareholders in the form of dividends, but when they do that, those dividends, of course, are taxable to the shareholder. We talked about that in part one of this course, but the dividends are not considered a deduction on the corporation's return. So in other words, the corporation has got their income for the year and they've got their expenses for the year. And of course, their expenses reduce their income and reduce the amount of tax that they pay. But a dividend is not considered an expense of the corporation. So there is no tax deduction. So this leads to what we call double taxation, because the profits from the C corporation are going to be taxed twice. First, the corporation itself is going to have to pay 21% tax on the profits. And then when they distribute those profits out to the shareholders are going to have to pay tax at their tax rate. So the same profits are being taxed two times, thus the phrase double taxation. Next corporation is a personal service corporation. It is simply a special type of C corporation. So it is still a C corp. It is sometimes formed as what's called a professional corporation under state law. The personal service corporation is for performing personal services, thus the name. So it's for areas such as accounting, medicine, law, architecture, etc. As with other C Corps, a PSC does pay a flat 21% tax on its taxable income, and it is subject to double taxation. The PSC is also subject to the passive activity loss rules. So back in part one, we talked about individuals being subject to the passive activity loss rules. A personal service corporation is also subject to those passive activity loss rules. Generally, the PSC must have a calendar year for its tax year. We're going to talk more about tax years here in a little bit, but other C corporations do not have to have a calendar year, but a PSC does. And the PSC can elect S Corp status if it would like. So the advantages and disadvantages of a C corporation. The advantages are that liability protection, of course. Also, they can issue multiple classes of stock with an unlimited number of shareholders, and this is different than an S corporation that we will be talking about next. The income tax rate is 21%. Remember, for other entities, you're paying the tax at your personal tax rates, which can be higher than 21%. Remember, the personal tax rates can go all the way up to 37%, whereas at least right now, the corporation tax rate is only 21%. So you might actually pay less income tax as a C Corp than you do as an S Corp, although remember, we'll be talking about the double taxation as well to keep in mind. There are certain fringe benefits that can be provided for employee shareholders of a C Corp that are not allowed for an S Corp. And so that can be an advantage of a C corporation. And then there is this potential for a Section 1202 exclusion of gain on sale. If you'll remember again back in part one, we talked about this 1202 exclusion. That's where you can exclude up to $10 million on the gain of sale of certain C corporation stock. You do have to meet specific requirements, but if you meet those, that is a huge advantage. And there are some people who start their business as a C corporation specifically because they hope to one day sell that business at a large gain, and they want to be able to exclude that gain under Section 1202. The disadvantages of a C corporation are the very high administrative requirements that we talked about, along with the fees and costs. It's generally just more expensive to have a corporation than the other types of businesses. There is that double taxation that we talked about. So you get taxed both at the corporate level at that 21% rate, and then again at the personal level when the dividends are issued. However, there are strategies for owners of small corporations to lessen the impact of that double taxation. We'll talk more about that when we get into the specific entity videos. Net operating losses of a C corporation do not pass through to the shareholders. They are only treated at the corporation level. Capital gains are going to be taxed at the same 21% corporate tax rate as all the other income of the corporation. So remember, for individuals, the capital gain rates are either 0, 15, or 20%. So if you have those same gains within a C corporation, they're going to be taxed at a higher rate. And then also, any capital losses from the C corporation are not passed through to the shareholders. So they're going to kind of be stuck there at the corporate level. And then there is no qualified business income deduction for a C corporation. So you don't get that benefit that you have with the other types of entities. Now let's talk about an S corporation. So this is also called a small business corporation. They file their return on a Form 1120S. So the 1120 is for the C Corp, the 1120S is for the S Corp. And they are considered a pass-through entity, meaning they usually do not pay income taxes. You will sometimes hear an S corporation described as a corporation that is taxed like a partnership. And that is generally true. There are some differences between partnership and S corporation taxation. But if you just think about it big picture, that is kind of true. They're a corporation, but they are a pass through entity, meaning that the profits and losses are going to be reported to each shareholder on their Form K1, just like you have with a partnership. And then the shareholders are going to report those amounts and pay tax on their personal 1040 if they are individual owners of that S corporation. So the profits are said to pass through to the shareholders. Now, the corporation, just like with a partnership, they may or may not distribute their profits, but it doesn't matter from a tax standpoint. The shareholders are going to be taxed on their share of the profits from the S Corp, whether or not those amounts are distributed. When they do get distributions from the corporation, those are dividends, of course, those are not subject to the self-employment tax, which may provide an advantage over either a sole proprietorship or a partnership. So with a partnership, all of those profits, whether they're distributed or not, are going to be subject to the self-employment tax. It does not work that way with an S corporation. The amounts that are earned by the S corporation are not automatically going to be considered self-employment income, and even the distributions that are made by the S corporation will not be subject to self-employment tax. So we'll talk more about all of that when we get into the individual entity videos. Pros and cons of an S corporation: you get the same liability protection as a C corp. Remember, as far as the state is concerned, you're just a corporation. You're not a C corp or an S corp, so you have the exact same liability protection as a C corp. It is a pass-through entity, so there's no double tax like with a C corp. Net operating losses pass through to the shareholders to offset their other income. There is no self-employment tax on those dividends. However, you do have to pay a reasonable wage if the shareholder works in the business. So we'll talk about that again in the S Corp video. And the shareholders, if they're individuals, they do get the qualified business income deduction on their Form 1040. The disadvantage is only one class of stock is allowed. So remember, with the C Corp, you can have many different classes of stock. With an S Corp, you can only have one class of stock, and there is a maximum of 100 shareholders. A C Corp, you can have an unlimited number of shareholders. With an S Corp, maximum is 100. The shareholders do not get basis in the S Corp for personally guaranteeing loans. So we talked about this when we were talking about partnerships. Partners do get basis for guaranteeing loans. S Corp shareholders do not get basis for guaranteeing loans, which means S Corp shareholders may not be able to deduct as many losses as a partner in a partnership could. Personal tax rates are going to often be higher than the 21% corporate tax rate if they had remained a C Corp. The income is going to be taxed whether it is distributed or not. So you could have that situation where the S Corp shareholder has to pay tax on the profits, but they don't have cash from the corporation to help them pay that tax. And there are some fringe benefits that are going to be taxable to a greater than 2% shareholder of the S Corp that would not be taxable if they were a C Corp instead. Our next entity is a limited liability company, or LLC. This is a state law entity that allows for liability protection that is very similar to that of a corporation. I am not an attorney. I think there may be some subtle differences in there, but for all practical purposes, you get the same liability protection with an LLC as you do with a corporation, but you have many fewer formalities and costs than you do with having a corporation. So you don't have to keep that corporate book and have a board of directors and do all of those things. So it's a lot simpler than a corporation with essentially the same liability protection. It is formed, of course, under state law. The owners are called members, and you can have as few as one member. We usually call that a single member LLC or an SMLLC, or you can have multiple members. Usually there's no limit, and we will sometimes call that a multiple member LLC or MMLLC. Remember, this is a state law concept, not a tax one. There is no such thing as LLC tax returns. The LLC has become probably the most common form of business entity that there is. They started just back in the 1980s, which, if you think about it, is not all that long ago compared to, say, a corporation. But the LLC very quickly became very popular because it was so much easier for small business owners to not have to follow all of those formalities and everything of a corporation. Plus, as you'll see, it has some unique tax treatment that can happen that makes it also very attractive for small business owners. The default for a single member LLC is to be taxed as a sole proprietorship. In other words, if you just go to the state, you form your LLC, you don't file anything else with the IRS, you will be taxed as a sole proprietorship. The LLC is what is called a disregarded entity. In other words, the IRS just pretends like it doesn't exist. You just file your Schedule C, just like with any other sole proprietorship, with your Form 1040. It is, however, treated as a separate entity for employment taxes and some excise taxes. So for income taxes, if you are a single member LLC, it is a disregarded entity. But for employment taxes and excise taxes, the LLC is recognized as a separate entity. The default for a multi-member LLC is to be taxed as a partnership. So again, you have a multi-member LLC, you don't file anything with the IRS, you will just be treated as a partnership, file a Form 1065, etc. Any LLC, whether single member or multiple member, doesn't matter, can elect to be taxed as either a C corporation or an S corporation, and we will talk about that here coming up. The advantages of an LLC, as we said, you get limited liability and you get tax flexibility. And this is a big one and the big tax reason to have an LLC. The LLC can choose to be taxed as a C Corp or an S Corp, or they can just remain being taxed as a sole proprietor or as a partnership. So they have lots of flexibility and they can change their entity choice as the business matures. So you can start out, for instance, let's say you're a single member LLC, you can start out being taxed just as a sole proprietorship. And then once the business is going, gets a little bigger, you might decide, you know what, it's better to be taxed as an S Corp. So then you can elect to be taxed as an S Corp at that time. And then the fees and the paperwork are going to be less than you have with a corporation. So that makes it a lot easier. The disadvantages of an LLC is it's not as easy to raise capital as with a C Corp. You can't just issue shares of stock as you can with a corporation. Depending on which entity type you choose, there may be some fringe benefits that are either taxable or not available to you. and the fees and paperwork are higher than with a sole proprietorship or a partnership. So the fees and paperwork is an advantage compared to the corporation, but it is a disadvantage compared to a sole proprietorship or a partnership. Changing entity classification. So as we've said, certain entities can choose to be taxed as either a C Corp or an S Corp. If they wish to be taxed as a C Corp, so this is going to apply to LLCs, LPs, LLPs. If they would rather be taxed as a C Corporation, they can do that by filing this Form 8832. And it is important to mention that a corporation cannot elect to be taxed as a partnership or a sole proprietorship. It doesn't work both ways. The other state law entities can elect to be taxed as a corporation, but the corporation cannot elect to be taxed as a partnership or sole proprietorship. If one of those entities wants to be taxed as a C Corp, they need to file that 8832 no more than 75 days after the requested effective date and no more than 12 months before. So let's say a calendar year entity wants to be taxed as a C Corporation as of January 1st, 2024. They would have to file this 8832 within 75 days of January 1st of 2024. So that's going to be sometime in the middle of March. Although a late election may be allowed by the IRS under certain circumstances. But once that election is made, it generally cannot be changed for 60 months. So if you're going to make the C Corp election, you want to make sure you really want to do it, because usually you cannot change that for 5 years. If an entity wants to elect S Corp status instead, they can do that by filing a Form 2553. And you're going to find that this is much more common than an entity making a C Corp election. Usually, when they are making an election to be taxed as a different type of entity, it is going to be as an S Corp. Technically, what a non-corporation should do is first file an 8832 to be taxed as a corporation, and then file a 2553 to be taxed as an S Corp. However, the IRS is actually being reasonable here, and they're saying, we're going to let you just skip that first step. You don't have to worry about filing the 8832. If you are, for instance, an LLC, you want to be taxed as an S corporation, you just file this Form 2553 in order to make that election. The S Corp election must be filed no more than 2 months and 15 days after the requested effective date, or any time during the tax year preceding the effective date. So again, if you got a calendar year entity, they want this as of January 1st of 2024, they have to make that election by March 15th of 2024. Now note that that is similar to the 75 days that you have for a C Corp, but it's not exactly the same. For the S Corp, it has to actually be by March 15th. That is not quite 75 days from January 1st, because February is a short month. So the C Corp, you'd actually have until, I don't know, March 16th or 17th. You'd have to count out the days. But for an S Corp, it does have to be by March 15th for a calendar year entity. And once this election is made, it can be revoked. But if you revoke it, then you can't make the S Corp election again for 5 years without IRS consent. So you will want to keep that in mind when you are making or revoking an S Corp election. Let's move on now to talk about getting started. So if you're starting a business, what are some of the things that you need to consider and to do? The first question you're going to have is, do you even have a business, or do you just have a hobby? So if you have a hobby, you're going to report your income minus your cost of goods sold as other income on your personal tax return. Other expenses you are not going to deduct. And you cannot report a loss from a hobby. You would not use Schedule C or Schedule F, and you do not have to pay any self-employment tax on any profits that you have from that hobby. If instead you have a business, you can report all of the income and expenses. You can have a loss from that business that can offset your other income. You would report it on Schedule C or F, and of course you would pay the self-employment tax. So sometimes what you have is individuals will have a hobby that they do. It can be a somewhat expensive hobby, and they may get some income from this hobby along the way, but usually their expenses are going to be larger than their income. And so then they will want to report that on their tax return as if it were a business and then use that loss to offset their other income. The IRS, of course, does not want people deducting their personal hobbies as a business loss. So the IRS can come in and dispute that you actually have an actual business, and they can say, no, it is a hobby instead. And so you can have these disputes between the IRS and the taxpayer. So, how do we decide whether it is a hobby or a business? Well, it's not always black and white. You have to look at several factors. So these are the factors that would be in favor of the activity being a business rather than a hobby. First of all, is it operated in a business like manner? And do they keep books and records? That would make it look more like a business. Also, the time and effort involved could indicate an intention to make a profit. So, how much time and actual effort are you putting into this activity? If you depend on the income from that activity for your livelihood, then that points very strongly, of course, to it being a business. Any losses that occur are due to circumstances beyond your control. So it's not an activity that you would just expect to have losses. You'd be like, of course you're going to have a loss. There's no way you're going to make a profit doing that. Rather, any losses that you have are really not in your control. So, for example, there's a worldwide pandemic and businesses are shut down. That's why you had a loss. That might be a reason that would show that, hey, it's outside of my control. That's just one example. Next, you or your advisors have the knowledge to carry out the activity. So, is this something that your life experience and education has prepared you to do? Then that would show that it's more likely to be a business. Also, if you were successful in a similar business in the past, then that would show that this activity is also likely to be a business. Whether the activity makes a profit and how much profit it makes can be one of the factors. And then also, if you can expect to make a profit in the future from the appreciation of assets. So, if you've got certain assets that you are investing in, maybe you're not making a profit now, but you can reasonably anticipate making a profit later because those assets appreciate, that would point to it being a business rather than a hobby. There are certain times when there will be a presumption that it is a business, and the IRS will not argue. If the activity generated a profit in at least 3 of the last 5 years, including the current year, then the IRS will presume that it is a business. If that activity is one that involves breeding, training, showing, or racing horses, then you just need to show a profit in at least 2 of the last 7 years, including the current year. So the IRS is acknowledging that it's more difficult to show a profit for an activity involving horses. So you just have to have a profit in 2 of the last 7 years, but it does have to include the current year in order to get this presumption that it is a business. Now, keep in mind, even if you fail these tests, you still might be a business based on that previous list that we looked at. It's just that if you do pass these tests, then you don't have to worry about it. You will automatically be considered a business. When you start a business, you will likely want to get an employer identification number or EIN. This is kind of like a social security number for a business. And despite the name employer identification number, you do not have to have any employees in order to get an EIN. The only business that may not need to get one is a sole proprietorship that does not have any employees or pay any kind of excise taxes, though it is still a good idea to get one so you don't have to use your social security number. In the real world, if I see somebody who's just got a small business like they are an Uber or Lyft driver or they do DoorDash or something like that, they may not need an EIN just because of the nature of the business. But any other type of business, I would advise that client to go ahead and get an EIN. You just want to have one. If you're going to the bank, you're setting up a separate bank account. you want to get a separate credit card, you want to do any types of things like that, you want to have a separate EIN rather than using your social security number. And the EIN is very easy to get. It's free. You just go to irs.gov. You can get it in 10 or 15 minutes. If you were searching around online and somebody wants to charge you money to get an EIN, stay away from that. It's a scam. Very easy to do yourself for free at irs.gov. Business classification. Doesn't matter what type of entity you have or what type of business you are in, you have to list on your tax return your business activity code. So this is a 6-digit number that comes from the North American Industry Classification System, or NAICS. These codes are listed in all the business tax return instructions, Schedule C, the partnership, the corporation, etc. They all have these lists of codes. You can also find them online, like you can just Google the code for your business, or your tax software will also have these codes built into it. You just choose the most accurate code for your business, even if it's not exact. So you may not have something that exactly describes what your business does. That's okay. You just take the one that is closest. So this is what those codes look like. And this is just one page of several pages. So this is why it's usually easier to look it up online rather than looking at these charts. But we'll have a closer look at the charts. Even by zooming in, it's still going to be hard to read. But you can see this is just page one. But you can see you've got agricultural, forestry, fishing, and hunting. And then under that, you've got oilseed and grain farming, vegetable and melon farming, et cetera, and so forth. So you have all of these different general categories and then very specific business codes underneath those. And you just look through this and find the one that makes the most sense. A tax year. You do need to choose a tax year for your business. C corporations can generally choose any month they wish to end their tax year. So this is called a fiscal year. I'm sure you've heard that before. C corporations and other entities like governmental entities will have a fiscal year. That just means it ends on some month other than December 31st. Generally, though, it does have to be the last day of a month. Except for this one exception, there is something called a 52 or 53 week year. In that case, you do not have to be the last day of the month. So, for example, you might say that our fiscal year ends on the last Friday in June. And so that can be the end of your fiscal year, even if that is not on June 30th. So you'll want to know that for the exam. You will see that once in a while out in the real world, but the vast majority of businesses will have a year end that ends on the last day of a month. Certain entities do have a required tax year, and often that is the calendar year. So, for example, an S corporation has to have a calendar year. A personal service corporation has to have a calendar year. Of course, if you have a Schedule C, a sole proprietorship, you are an individual, and individuals have a calendar year. So, you're going to see in the small business world that a lot of the entities have to have a calendar year. A partnership or an LLC must generally use the tax year of the majority of their owners. So again, if the majority of the owners are individuals, those individuals have a calendar year, so that partnership is going to have a calendar year as well. But remember, corporations can also be partners in partnerships. Other partnerships can be a partner in a partnership. So if you've got a C corporation, for example, with a May 31st year end, and they are the majority partner in a partnership, then that partnership needs to have a May 31st year end. Now, the IRS will allow exceptions to these requirements if there is a valid business reason to do it. So, for example, seasonality. If you had a ski resort, for example, it might make more sense for their year end to be at the end of March or at the end of April due to seasonality. So, if that is the case, then that business can apply in this Form 1128 with the IRS to adopt a tax year other than the year that they're supposed to have. And then the IRS will either grant that or they will not grant it. There's also something called a Section 444 election. So, this is for a business who wants to have a different tax year than their required year, but they don't have a valid business purpose to do so. So, for example, this could be due to an acquisition or a change in ownership that would normally require the entity to change its tax year. So, let's say you have an entity with a calendar year end, say it's a partnership calendar year end, and then a C corporation with that May 31st year end comes in and becomes the majority partner in the partnership. Well, as we discussed, that partnership is supposed to now have a May 31st year end to align it with its major partner, which is that C corporation. Well, the entity can go to the IRS and say, hey, we'd like to keep that calendar year. We've always been a calendar year. We're keeping this business separate from the corporation. It's really a separate business. So we want to keep the calendar year end. And you can request with the IRS to do that, and they may allow it. However, if they get any tax benefit from that different year end, then they could have to make required payments. These are Section 444 payments to offset the income deferral that the owners will get. So the IRS doesn't want you playing games with the tax years of entities in order to save or defer taxes. So, for example, let's say you have a C corporation with a calendar year end, and then they are a majority partner in a partnership. Well, they might say, okay, let's make the partnership year end January 31st. That way, we get an 11-month deferral on the income from that partnership. Because remember, that partnership's not going to issue a K1 until April after the C corporation has already filed their calendar year tax return. So they wouldn't have to include all of that income until their following year's tax return. So they would get an 11-month deferral of the tax from the income from that partnership. So the IRS says, no, you can't do that. If you want to have a tax year other than December 31st for this partnership, then we may allow it, but we're going to make you make these Section 444 payments to make up for the fact that you're getting this 11-month deferral. So this is just to stop businesses from playing these games and choosing different tax years to maximize their tax benefits rather than doing it for some legitimate business reason. You can have a short tax year that is less than 12 months long. Usually, this is when you are first starting a business or when ending it, though it can also result from adopting a new fiscal year that we have just been talking about. But a typical example would be like this: Jill forms Jill's Jewelry LLC on July 1st, 2024, and starts doing business that same day, electing to be taxed as an S corporation. Jill's Jewelry's first tax year will be from July 1st of 2024 to December 31st of 2024. Its next tax year will start on January 1st of 2025. So that first tax year is a short tax year, and this is what we mean by that. Income tax return due dates. A sole proprietorship is just an individual, so their due date is going to be April 15th. Similarly, a C corporation is a separate taxpayer. Remember, they are considered a separate person under state law, and they are considered a separate taxpayer under tax law. So their tax return is also due on the 15th day of the fourth month following the end of the tax year. So if they are a calendar year corporation, it would also be due on April 15th. Now, there is one odd quirk exception here. If the C Corp has a June 30th year end, then their tax return is actually due on September 15th, which is the 15th day of the third month following the end of the year rather than the 15th day of the fourth month. So that is kind of odd. It could be tested on the exam, so you'll want to remember that. But for all other C Corps, it is the 15th day of the fourth month. For the pass-through entities, the partnership and the S corporation, theirs are due on the 15th day of the third month following the end of the year. So let's think about this. Why would that be? Why would theirs be due on the 15th day of the third month, whereas the others are due on the 15th day of the fourth month? Well, let's think about it. Let's say you've got individuals who are a partner in a partnership. That individual has to file their tax return by April 15th, but they need the K1 from the partnership in order to file their tax return. So the partnership return is due a month earlier. It's due on March 15th in order to give the individual taxpayer time to file their tax return on April 15th. And then the same thing happens for the S corporation. So just remember the pass-through entities, the partnership and the S corp, 15th day of the third month, whereas those that are their own taxpayers, which is individuals and C corporations, are due on the 15th day of the fourth month. Record keeping requirements. When it comes to dealing with the IRS, you need to remember three things: documentation, documentation, and documentation. Documentation is everything when you are dealing with the IRS. You need to keep books and records of your accounting transactions, usually in the forms of ledgers, journals, entries, etc., showing all of your income and expenses. These days, this is often done in different types of accounting software, but it does not have to be. And there are plenty of small businesses who are still doing it by hand, or maybe they're keeping some records in Excel or something like that, but not specifically in an accounting software. That is fine as long as they are keeping those records and they're easy to follow and they can be used in case of an audit to support what is going on with the tax return. You also want to keep your records and receipts to establish those numbers that are in the books and records. So this would include invoices, bank records, sales slips, receipts, bills, canceled checks, etc. Those things can also be kept electronically, or you can keep paper copies of them. You do want to keep paper copies of some of your more important legal documents and other important papers. You can have them electronically, but it's always good to have the paper versions as well, especially if it relates to real estate or large purchases such as vehicles, machinery, and equipment. You need to keep these records for as long as they are needed for the administration of the tax law. So, under normal circumstances, the statute of limitations for an IRS audit is 3 years after the original due date of the return or the date the return was actually filed, whichever is later. So, you want to keep the records for at least that long. All employment related records must be kept for 4 years, and any records establishing the cost or basis of assets needs to be retained until the statute of limitation expires on the year that the asset is disposed of. So, for example, you could have a building that is bought in a business, and the business holds on to that building for 30 years or more. So, let's say they held on to it for 30 years. You would need to keep that closing statement and those documents from buying that building for 33 years. You'd have to wait the whole 30 years, and then the year you sell it, you have to wait for 3 years after that tax return is due to get rid of those documents. So you need to keep them for that long. So you need to think about that when you're thinking about file storage and all of those things. Again, you can also keep an electronic copy, and I certainly would do that. But for those more important and larger assets, you want to keep that paper copy as well. Commingling. You do not want to commingle personal and business funds. There should be a clear distinction between business and personal income, expenses, etc. I will tell you from experience, many small business owners are not very good at this. They've got credit cards that they're using for both personal and business expenses. They've got bank accounts they're using for both personal and business expenses. It happens all the time. That does not make it right, and that does not make it a good thing. You want to stress with your clients that they should keep their business and personal financial records separate. Have a separate credit card for your business expenses. Have a separate bank account for your business transactions. If you get audited, the IRS is going to look upon commingling with suspicion. They're going to say, well, you've got some things that are business, some things that are personal. Do you even have a business? So when you go back to that hobby versus business thing, they could say, you don't really even have a business. This is just all going through your personal account. Or they can say, well, you've got all these personal things in there. How do we know that this thing that you say is business is really business? We're not going to allow it. It's in your personal account, your personal credit card. We're just going to disallow it. And then you're going to have to prove that, no, 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 it really is business. But it can really be a hassle because you can have a lot of business expenses that are denied because you did this commingling. So don't commingle, keep everything separate. If you have clients who did not do this, and you're going to have those that come in without separate records, you want to make sure that they can clearly distinguish which transactions are business and which are personal. So this is when you're really going to have to make sure they've got those receipts or invoices or other things to back up what they are saying so that those do not get denied when it comes to an audit. Related party transactions. Transactions between owners or their families and the business, or between two or more businesses that are owned by the same persons, should be very carefully conducted and documented. You can do it. It's not that you can't have transactions between related parties. It's just that if you do have transactions between related parties, there is going to be extra scrutiny by the IRS. So you want to have a good paperwork trail showing that the transaction was handled in a business-like manner. So you want to treat the transaction as if you were not related parties. So if you were doing the same transaction with someone who is not a related party, what would you do? What kind of agreements would you have in place? What kind of contracts would you sign? What terms would you use? You want to make sure that you're using fair market value for sales transactions or for rental transactions. You want to treat related parties just like you would treat someone who is not a related party. If you don't, then the IRS can step in and change what has happened with that transaction. Even if you do follow all of these formalities and do the things that you're going to do, there are still going to be special rules. As we go through these videos, you'll see where we say, well, if you've got related parties, then this rule applies, or you're not allowed to do this, etc., and so forth. So you'll always want to follow those rules, but you really want to just make sure if you are doing something with a related party that you are dotting your I's, crossing your T's, watching your P's and Q's, whatever metaphor you want to use to make sure that you are doing things carefully and that you are being objective. Reporting requirements. So, of course, for your business, you're going to have an income tax return. We'll be talking about that throughout these videos, but there are also some other reporting requirements that you may have. So some of the things that you may have and that we're going to look at are these: W-2s, W-4s, W-9s, 1099s, a Form 8300, or an F-bar, and there are others, but we do want to make sure that you are aware of these, so we are going to talk about them. First are W-2s. If you have employees, then you must issue them a W-2 each year. If you've ever had a job in the United States, you are familiar with a W-2. This is the form you get at the end of the year that tells you how much you made, how much was withheld, etc. You use it in order to prepare your personal tax return. So as a business owner with employees, you have to issue these W-2s each year to your employees. They are due by January 31st. So you send a copy to the employee by January 31st, and you send a copy to the government by January 31st. That way, the IRS knows that the employee had that income, and so their computers will do a match. And if the employee does not report the income, then the IRS will automatically audit them. So that is the W-2. Next is the W-4, which is the employee's withholding allowance certificate. Again, if you've ever had a job in the United States, then you're familiar with this. When you first get hired, you have to fill out this W-4. You give the employer your name, your address, your social security number, marital status, and then you're going to list the number of exemptions that you would like. It does only have to be done once, but the employee is allowed to fill out a new W-4 anytime they want to. If the employee does not fill out the W-4, the employer still has to withhold taxes. It's just they have to do so at the highest withholding rate, which is treating that employee as if they are single with no exemptions. The W-4 is not filed with the IRS. The business just keeps it in their files. Of course, the IRS can ask to look at those if they do an audit. Next is the W-9, which is a request for taxpayer identification number and certification. So a business may ask an individual or another business to fill out a W-9. Or a business might be asked to fill out a W-9 for a different business who is requesting it of them. So, what is the purpose of this? The reason you are requesting a W-9 or someone is requesting you to fill out a W-9 is because of 1099s. So, if you think that you have to issue a 1099 to someone, we're going to talk about 1099s next. But if you, as a business owner, believe you are going to have to issue someone a 1099, you send them this W-9. And then what they do is they report back to you their name, address, their employer identification number, etc. And then they give you some information to know whether or not you need to issue them a 1099. And if so, the information you need to put on that 1099. The W-9s, again, are not sent to the IRS. You just keep it in your records to support your 1099s that you send out. So now let's talk about those 1099s. There are several different 1099s that you can have to fill out. One of the more common ones is the 1099 NEC, that stands for non-employee compensation. So whenever a business pays $600 or more in a year to a non-employee, either individual or non-corporate entity, for performing services, then you have to issue a 1099 NEC to that individual or non-corporate entity. So this could include things like bookkeepers or accountants, lawyers, a landscaper, computer maintenance, computer programmers, anybody who's not an employee. So you're not issuing them a W-2, you would issue them a 1099 instead. This is usually not required if the person you're paying is a corporation or is taxed as a corporation. So they might be an LLC, but they have chosen to be taxed as an S corporation. Well, they'll let you know that on that W-9. So usually if that's the case, then you do not have to issue them a 1099. There are exceptions. The main exception is for attorneys. Even if the attorney is incorporated, if you pay them $600 or more, you do have to issue them a 1099. For the 1099, like a W-2, you have to send it to the recipient by January 31st, and you're also going to file a copy with the IRS by January 31st. And again, this way the IRS knows that that person received this income, and so they can, again, try to match that up with their tax return to make sure that that person reported the income on their tax return. Another type of 1099 is the 1099 miscellaneous or 1099 MIS, M-I-S-C. This is for reporting, again, $600 or more per year of rents, royalties, or other income to any individual or non-corporate vendor. Most commonly, it is used for rent, and it also must be sent to the recipient by January 31st. However, you can wait. If you're filing it on paper, you can send it to the IRS by February 28th. And if you're filing it electronically, you can send it by March 31st. There are lots of other types of 1099s that have to be issued in specific circumstances. Some examples: 1099 INT for interest, 1099 DIV for dividends, 1099B for broker and barter transactions, 1099C for cancellation of debt, etc. There are several others. We're not going to list all of them. If you file 10 or more information returns in total, you must file them with the IRS electronically. So you have to add up all of your information returns, so all of your W-2s, all of your 1099s. If you add all of those together, if you have 10 or more, then when you file them with the IRS, you have to file them electronically. This used to be 250. Used to be before the 2023 tax year, that if you had, say, 200, you could file them with the IRS on paper, but no more. You can only file on paper if you've got 9 or fewer. If you've got 10 or more, has to be electronic. Next is the Form 8300. This is the report of cash payments over $10,000 received in a trade or business. So if in the course of your business you receive over $10,000 of cash in a single transaction. So when we say cash here, we don't mean like a check. We mean actual greenbacks, actual cash. Somebody brings in $100 bills and $20 bills, etc. If they pay you more than $10,000 in a single transaction, you have to report that to the IRS. So let's say you've got a used car lot and you sell somebody a car for $15,000 and they pay in cash. You have to report that on this Form 8300. Let's say instead they pay you $5,000 now and $5,000 next week and $5,000 the week after that for that car. It's all related to one transaction. Again, you would have to report that on this Form 8300. You have to file the 8300 within 15 days of the cash transaction. You also issue a statement to the party involved by January 31st of the following year. So you let them know, hey, I filed this Form 8300 with the government. You can also file the 8300 for amounts less than $10,000 if it seems suspicious. So let's say somebody brings to you exactly $10,000 or $9,900, and it just seems kind of odd to you, and you want to report it, you can. You fill out this Form 8300 and you send it in. In that case, you do not send a statement to the party involved. So you're not going to let them know that you kind of squealed on them by sending this form to the government, but you are allowed to send it in if you want to. The F-bar. We talked about the F-bar back in part 1, but we're going to go over it briefly again here and to remind you that it does not just apply to individuals, it also applies to businesses. So it is any corporation, partnership, limited liability company, trust, estate, doesn't matter. If you meet these requirements, you have to file this F-bar. You file it if your business, in this instance, had a financial interest in or signature or other authority over at least one financial account located outside the United States if the aggregate value of those foreign financial accounts exceeded $10,000 at any time during the calendar year. So if even for one day during the year, the total of all your foreign accounts exceeded $10,000, then you have to file this F-bar. It is due on April 15th of the following year. It is not an IRS form. You do not file it with your tax return. And it doesn't matter what your year end is. So you could have a C corporation with a July 31st year end. This is due on April 15th of each year. That's when you file the F-bar. You can get an automatic extension to October 15th. This form has to be filed electronically, not on paper, through FinCEN's system. And if you do not file it, it is a penalty of $16,117 unless it was a willful failure to file. In other words, you're trying to hide something, then the penalty can be much more than that. Withholding and payments. If you are an employer, then you've got two responsibilities. First of all, you are going to withhold from your employees' paychecks federal income tax, Social Security, and Medicare tax. So the employee will be paying those amounts, but you as the employer will be withholding those amounts and remitting them to the government on the employee's behalf. In addition to that, as the employer, there are certain amounts you have to pay from your own funds. So you have to pay the employer's share of Social Security and Medicare, which is 7.65%. So you're going to be withholding from the employee 7.65% for Social Security and Medicare. And then you are going to be paying out of your own funds 7.65% of Social Security and Medicare. You are also responsible for paying federal and state unemployment tax. So that comes out of your own funds. You may also need to withhold state and local income tax depending on whether or not you live in a place that has those taxes. For the amounts that are withheld from the employees for income tax, as well as Social Security and Medicare tax, along with the employer's share of those taxes. So these are the amounts that you withhold and the amounts that you have to pay in. You have to report that to the IRS in a timely manner. You report it on this Form 941, the employer's quarterly federal tax return. If you happen to have less than $1,000 per year of all of these amounts, then you can just report annually on the 944. But for the vast majority of employers, you are going to report on the 941. This is due the last day of the month following the end of the quarter. So it's April 30th, July 31st, October 31st, and then January 31st of the following year. So that is how you report the amounts that you are going to pay. However, you have to pay the amounts more often than quarterly. So you're going to pay them either monthly or semi-weekly, depending on how much you historically have had to pay in. So you don't pay them in with the 941. The 941 is for the reporting. You will make the payments through the Electronic Federal Tax Payment System, or EFTPS. If you do not pay in a timely manner, you can have penalties that range between 2% and 15% of the amount due. And then you'll also want to remember that there may be state both reporting and payment requirements as well. Those aren't tested on the EA exam, but you want to remember that you may have state requirements along with your federal requirements. Trust fund recovery penalty. If the amounts that are withheld from your employees for Social Security and Medicare, those are called trust fund taxes. If they are not turned over to the IRS, a penalty of 100% of the amount due can be imposed. If the business does not have the funds to pay that, any individual who acted willfully can be made to pay those amounts. So anyone involved with the business, if they were involved in not paying this money over to the government, they can individually have to pay the amounts over and have to pay this 100% penalty. So basically, have to pay double the amount that was withheld. This can include officers of the company, accountants, partners, or even volunteer directors can be held personally liable for these amounts. And you do not get any liability protection because you're a corporation or an LLC or whatever. That does not apply to this. The IRS takes this very seriously, as they should. These are amounts that have been withheld from your employees. And unfortunately, if you follow the news, you will see these cases come up way too frequently. Some business owner withholds all of these amounts from their employees, and then instead of sending that money to the IRS like they're supposed to, they go out and they spend the money instead. And so they get caught and they go to prison. And not only do they go to prison, but they have to pay these amounts. And if that business owner cannot afford to pay it, say all the money's gone, then the IRS can look to anybody else who may have been involved in that. Anybody else who was also complicit in not paying that money over to the IRS can be held liable and have to pay these amounts. So this is a really big deal. And so you want to make sure that your clients are following the rules. Self-employment tax. We talked about self-employment tax in part 1, so we will be talking about it some more here in part 2. But as you will remember, self-employed taxpayers are considered both the employer and the employee for payroll tax purposes, even though they're not getting a paycheck, they're not getting a W-2. So instead, what they do is they have to pay this self-employment tax. It's 15.3%. That 15.3% is the 7.65% that the employee would be paying in Social Security and Medicare, added to the 7.65% that the employer would be paying in Social Security and Medicare. The Social Security portion of that, so the 12.4%, is due on the first $168,600 of net earnings from self-employment. That is the 2024 number that goes up each year with inflation. There is no limit on the 2.9%. So you pay the 2.9% on all of your net self-employment income. You pay the 12.4% just on the first $168,600. The SE tax is reported and paid on the Form 1040, as we saw in Part 1. You use Schedule SE, and as you'll remember, the individual gets a deduction. It's an adjustment to income for 1/2 of their self-employment tax paid, which that represents the employer's share. So it's putting the self-employed individual on the same footing as a business, because a business gets to deduct their half of the Social Security and Medicare that they pay on their employees. And so this is allowing the self-employed individual to do the same. FUTA, which is the federal unemployment tax, employers generally must pay 6% of the first $7,000 of wages per employee per year for federal unemployment tax. So that is a maximum of $420 per year per employee. It must be paid by the last day of the month following the end of the calendar quarter. So again, that's April 30th, July 31st, October 31st, and January 31st. You report it annually on a Form 940. So you have to pay in every quarter, but you only have to report it once per year on the 940. And then also, you don't want to forget that there may be state unemployment tax and filing requirements as well. Sales tax, not a federal tax, not going to be tested on the EA exam, but don't want you to forget about it. The business may be responsible for collecting and turning over sales tax, and it will either be to their state or their county or their city, depending on where you are in the country. Our last topic for this video is worker classification. This has to do with whether people who do work for the business are considered employees or independent contractors. As we discussed, businesses must withhold and pay payroll taxes for employees. They do not have to withhold or pay payroll taxes for independent contractors. This gives the businesses an incentive to designate people who work for them as independent contractors versus employees. Therefore, there are guidelines you must follow in determining how to classify workers. So this can be a very big deal. We just talked about how the business has to pay 7.65% of their employees' salary for their portion of Social Security and Medicare. They also have to pay federal unemployment taxes. Well, if those people are not employees, if they're independent contractors instead, then the business does not have to pay those amounts. Also, if they are employees, those people may be entitled to certain benefits under the law. Nothing to do with taxes, but they may be entitled to other benefits such as health insurance and paid time off and other benefits that they can get because they are employees. So what will happen then is you will have some employers who try to say, oh no, these people aren't employees, they're independent contractors. And then the government will step in and argue and say, no, these are actually employees. This could be the IRS that's saying this. It could be the Department of Labor that is saying that. But someone from the government will be stepping in and suing the business and saying you are improperly showing these people to be independent contractors when in fact they are employees. And then these cases go to court and they can involve many millions and millions of dollars. So let's talk some more about that. The classification of being an independent contractor versus an employee is going to depend on the facts and circumstances of each case. It hinges on the degree of control the business has over the worker. And when we talk about the degree of control, we're going to look at three main areas: behavioral, financial, and the type of relationship. Behavioral. Does the company control or have the right to control what the worker does and how the worker does his job? Financial. Are the business aspects of the worker's job controlled by the payer? So this would be things like how the worker is paid, whether expenses are reimbursed, who provides the tools, the supplies, etc. And then the type of relationship. Is there a written contract between the employee and the business? Does the individual get employee type of benefits, such as a pension and insurance and vacation pay? Will this relationship continue, and is the work performed a key aspect of the business? So these are all questions that will be looked at to determine, is it an employer-employee relationship, or is it more of an independent type of relationship? If you are not sure which is correct, either the business or the worker can file this Form SS8 with the IRS, and the IRS will make the determination for you. If a worker is classified as an independent contractor and they don't agree, they think that they should be an employee instead, then what they can do is first they should file the SS8. But then after they filed the SS8, they can file this Form 8919 reporting uncollected Social Security and Medicare tax and say, hey, this should have been collected from me and it was not. And this will then prompt the IRS to go ahead and look at that on behalf of the employee. The penalty for misclassifying employees as independent contractors could include being held liable for employment taxes for past work and for other employment-related costs and penalties. As we said, this is very controversial. It is frequently litigated, and it can involve millions and sometimes tens of millions of dollars, depending on the size of the business that is involved. Statutory employees. There are some workers who will automatically be classified as statutory employees for purposes of Social Security and Medicare taxes. So they are issued a W-2. Social Security, Medicare taxes are withheld and paid, but they report their income and expenses on a Schedule C. So it's kind of a hybrid situation. They're an employee for payroll tax purposes. They are self-employed for income tax purposes. So they do not have to pay self-employment tax because Social Security and Medicare is already being paid, but they do fill out a Schedule C to show their income and expenses. So some examples of these would be a route driver who's acting as an agent or works on commission. A full-time life insurance sales agent can be a statutory employee. An individual who works at home on materials or goods that you supply. So the business supplies the materials and says, here, put together this widget. And that person is working at home. They could be a statutory employee. And then a full-time traveling or city business-to-business salesperson who sells merchandise for resale or supplies. So this, again, is for business-to-business sales. So this could be someone who is selling to stores. They've got a product. They're going business to business, and they are selling this product to stores who are then, of course, going to resell it to the retail customers that come into their store. Those salespeople can be considered statutory employees. Statutory non-employees. So these are workers who are automatically going to be classified as not being employees, and the IRS and the government will not argue with them. So they are considered to be self-employed for federal income and employment tax purposes. There are three categories of these statutory non-employees: direct sellers, licensed real estate agents, and certain companion sitters. So for direct sellers and licensed real estate agents, they will qualify as a statutory non-employee if substantially all the payments for their services are based on sales or other output rather than hours worked. So in other words, they're working on commission. So that's the first thing. They're working on commission. And they've got a written contract where they agree that they are an independent contractor. So this is typical, for instance, in the real estate industry. The real estate agents will be self-employed individuals because this is the type of arrangement they have. They're only getting paid commissions for the houses they sell, and they have a written agreement that says, I understand I am an independent contractor. So they will be considered a non-employee, and there will be no argument from the IRS. For companion sitters, the rules are a little bit different. A companion sitter is someone who provides personal attendance, companionship, or household care services for children, the elderly, or the disabled. So a business that puts such persons in touch with clients will not be treated as an employer. So here we're talking about an agency, and you've got some people who need a companion sitter, and you've got some people who want to be companion sitters, and you've got this agency in between that matches them up. Well, as long as that agency does not receive any payment or wages for or pay the companion. In other words, the agency is not the one paying the companion. It's the end client who needs the companion. They're the ones that are paying the companion. And that agency is simply being paid a fee, either by the companion or the client. So the agency is just making money by being a matchmaker, and then they're not involved anymore. So they match the two together, they get a fee, and then that's it. From then on, the client is simply paying the companion sitter, and the agency is no longer involved. If you have that case, then those companion sitters are going to be considered statutory non-employees. And that is the end of video 1 for part 2. In video 2, we will discuss accounting methods and business income. So I will see you in video 2.